Thank you so much, everyone, for joining us for this webinar. The webinar of today will be on investment planning, and it will be it is part of our educational material for the month. So once again, thank you so much for joining us. Before we start, maybe I'll just like to introduce the team with me before I can just give a brief of Arima and even our parent company. My name is Christine Boro. I will be moderating the session for you today.
Oh, thank you so much. My name is Joseph. I'm the investment and private wealth advisor at Arima Fund. Thank you so much and feel most welcome.
My name is Wambuto Tiambo. I work under research in Arima. Thank you for joining.
Hello, my name is Joseph Chuguna, Communications at Arima. Thank you.
Hello, my name is Eric, and I'm a member of Arima.
So thank you so much. That is the Arima team. So before we begin, we also have Bernice. I'm not sure if she's introduced herself, but you'll get to know her as we get on with the presentation. Before we begin, I'll just like to tell you more about our parent company, Actuarial Services East Africa Limited. It is an actuarial consulting firm with over 20 years of operation, as well as business presence in over 13 countries in Africa. Some of our service areas are around investment consulting, pension fund consulting, life insurance consulting, post-retirement medical consulting, and our most recent service area product being the IFRS 9 and 17 consulting. So as a result, over the 20 years of our business operations, Active has been able to birth a couple of intermediaries. There's one, Brooks Insurance Agencies, which is our independent insurance intermediary that is licensed by the IRA to offer both life and general insurance products. We have Mavuli Pension Fund, which is a multi-employer retirement scheme that is designed to allow employees of a participating employer to save towards retirement. The last product intermediary is Arima Investment Fund, which is the team that is here with you today. It is a private membership-based investment club that seeks to enable its members to achieve financial stability, security and independence. So that is a brief about who we are and what we do. And the team that is here with you today is Arima Fund. So as we move along, you get to know more about our team and the Arima Fund and what it does. So at this juncture, I will introduce my colleague Andewo, who will just give a brief of what Arima Fund is all about before he can get into the presentation of the day. Before that, maybe just to welcome our guests once again and the participants who have been able to join us for the webinar today. As we move along with the presentation, if you have any questions or any clarifications that you may want answered, kindly engage with us in the chat box, and our team will be willing and ready to assist and answer any questions with and for you. So Andy will take it away.
Thank you so much, Bernice. We shall move to slide 2. And basically, I'll just give you a brief about Arima Fund. Arima Fund is a private member investment club that was established sometimes in 2014. It came into partnership with Actuarial Services East Africa, that is ACTSAF, which is a leading consulting firm in Kenya. The main aim then was to enable the fund basically engage and seek out superior investment opportunities. I'll briefly walk you, the audience, through our vision as well as and the purpose of Arima Fund. Our vision is basically to be an investment partner of choice for our members and their families. And our mission is basically to enable our members achieve financial stability, security, as well as independence by providing access to unique and rewarding investment opportunities not easily accessible elsewhere, as we are going to see in the subsequent parts of this presentation. Then when we talk about our purpose as a fund, it's basically to enrich and positively impact the lives of persons or people members by providing that needed access to investment, that is to their families as well as impacting that kind of social impact opportunities. Our member focus that drives us each and every day is basically the focus, integrity, reliability, innovation, teamwork, as well as professionalism. This basically allows us to achieve our vision, mission, and purpose as I've outlined. Among the services that we offer under Arima Fund basically includes family wealth management. We also do personal financial planning, as well as the investment planning that we are having under this webinar today. Why are we having this webinar? As part of our promise, as I've mentioned earlier on, in our mission and vision, as part of that promise of enabling our members achieve financial security and stability, as well as independence, we aim to continuously equip our members with that needed knowledge on various financial matters that we basically have in the market, in the Kenyan market, and even outside our boundaries. And as we all know that most people find it hard to decide where to invest their money due to availability of numerous investment options in the market. And for that reason, we are having this webinar of today. And thirdly, in this webinar, we also aim to equip you, the audience, and our members with the knowledge on how to decide which investment options basically suits you the best. We all know for a fact that the market has got quite a number of investment opportunities in various areas, including in real estate, in the stock market, in the bond market, in the money market, and various areas. So one purpose of this webinar of today is just to equip you, the audience, together with all our members who have already invested, with the knowledge on how to decide which investment option suits you the best. Allow me to move to the next slide and basically briefly talk about what is investment planning, because actually that's what we are doing today. I've talked about the mission of the fund, the vision, as well as the purpose of the fund. And the reason as to why we are having this webinar today. Investment planning, in simple terms, basically is the process of identifying financial goal or goals and converting such goals by building a plan. It is therefore a key component of financial planning that involves deciding on how money can be best put to work to achieve a particular financial goal. As an investor or as someone who is willing to begin this journey of investment, before you start your investment journey or before you decide on where to put your funds, it is always important to secure a strong financial foundation. And we are going to see going forward, how do you do that? At the same time, before you make that step of investing, it's always important to get educated about the investment space. This is the kind of education that we are all getting today, including us, which is very, very key before you make that needed step, before you make that step of investing. So allow me to move to the next slide, that is how do you secure that strong financial foundation? The basic steps to be followed includes having a sufficient reserve, or reserving basically enough money to help get through all the unexpected expenses. We are living during the hard times, and you may really not understand what is going to come next or what's going to happen next that probably will require some sort of finance. And basically, it is always advisable that you reserve enough money to help get through any and all the unexpected expenses that do come day in and day out. So we also need to pay off our debts in order to secure a strong financial foundation. Then you also get insured against any financial losses that probably are unforeseen, but they do occur. At the same time, to secure that strong financial foundation, you need to maximize out individual retirement account or any other tax-deferred retirement plan. Other than this basic step, you also need to get educated about the investment space. And the reason for this is basically that the world has its own language, market, and resources. And it is always very, very important for investors to familiarize themselves with this space. And how do you do so? By constantly consulting a professional financial advisor. You may as well subscribe to financial newspapers, periodicals, or by simply visiting a library. Without forgetting also the basic research that we have. You can also do your own personal research or get into the research papers done by professional bodies that touches on matters investment. Then lastly, you also need to interconnect with the knowledgeable investors. Right now, we have quite a number of persons attending this webinar. Most of them are investors. Some are also willing to begin their investment journey. We have talked about the strong financial foundation on one side and also getting educated on the other side. So interconnecting with knowledgeable individuals who have invested in any field of investment is very, very key. And this is a moment for us to interconnect. Even thereafter, after this webinar, we can always interconnect. It will help us really get educated and get to know more about what is available in the investment market in various segments that we have, for example, in Kenya or outside Kenya. Moving to the next slide. The investment itself, we have quite a number of terms that probably we do speak, but we may not, in most occasions, understand what they mean. One of them is the time horizon. When we speak about time horizon in investment or investment time horizon, this is basically the length of time that you as an investor, you as someone who is willing to engage or invest in a particular kind of area is willing to invest. That length of time as an investor is willing, keyword here is willing to invest. Are you going to invest for a short time? Are you going to invest for like a medium term? Or are you that kind of investor willing to take up the long investment opportunities that we have? Like if I talk about the bonds, basically do offer the 1-year bond, the 2-year bond, the 3-year bond, even up to 25-year bond given by the government, either in Kenya or outside. So bonds basically do offer that long duration of investment. And what are bonds? Bonds are basically the fixed income instrument that represent a loan made by an investor to a borrower. It can be a loan made by you as an investor, and the borrower in this case is the government of Kenya, giving you that loan, giving you that opportunity to invest by you loaning the government. And in this case, you become the investor. Then what do you get at the end of the day? What you get at the end of the day is basically the return. And this takes us to the point of the yield, the return of your investment. What basically do you get out of your investment is what we call the return or the yield. If you bought shares and probably the shares or the company that you have bought shares in. Give it an example. We may have the Actual Services East Africa, privately offered shares. We may have the Safaricom, publicly offered shares. When they make profit, they declare such profits. And the declared return to the investors or the shareholders is basically what we call the dividend. This still falls under the yield, the return on your investment. Then we also have the term risk. You are either a risk investor. People talk about being risk takers, but what is the term risk meaning? What does it mean basically? Risk is the probability of the investor making or losing. Keywords, you either make or you lose the money in an investment. This will really bring you now to what we call the risk tolerance. Up to what degree of variability in investment return that you as an investor, you are willing to withstand in the financial planning. This is what we call the risk tolerance. Then another key term is the investment portfolio. You may have like $1 million today, and you have a collection of investment that you have invested in. You might have invested in the stock market. You might have investment in government securities like treasury bonds and treasury bills. You might have as well invested in real estate. Name them. There are so many. This is what you call the investment portfolio, that collection of investment that you have as an investor. And what you have done in terms of like putting your money not in one basket or your eggs in one basket is basically what we call diversification or asset allocation. That is, you have decided to spread your money across a variety of investments to try to reduce the risk that we spoke about earlier on. Then liquidity is basically the ability to quickly convert that investment that you have into cash. Believe me not all investments are the same in terms of liquidity. Some are liquid, some are illiquid. For example, someone who might have invested in real estate, that is identifying a piece of land, developing it, and probably selling it out. When it comes to the point of selling it, upon developing it, it might not be easy to convert that kind of investment into cash that easily as compared to someone who have invested, for example, in a Arima fund and wants to convert their investment into cash. On one side, the real estate investor will take not less than 3 months before realizing their cash at that point of conversion. On the other hand, someone probably invested in the Arima fund will realize a period of 3 to 7 days to convert their investment to liquid cash. However, you may realize that the returns might be different in these two kinds of investments. But liquidity is that ability to quickly convert your investment to cash, which is also very, very key factor to consider before you make that key step of investing. Security, I talked about the bonds, I talked about government securities, treasury bonds, and treasury bills. Allow me to talk about stocks. Stocks is just a security that represents the ownership of a fraction of a company or a corporation. That is basically what we call stocks. And stocks basically are traded in the stock exchange. That is only for listed companies. Either you trade over the counter or in public. So that fraction of ownership, of that company you possess as an investor is basically what we call the stocks. Investment funds, if I may talk about it, is just a pool of capital that a number of individual investors pay into and other investment instruments. For example, in Arima fund, we have various investors coming in. So we have a pool of funds that come in. That pool of capital from investor 1, investor 2, investor 3, name them. That is what we call the investment fund. It is upon the investment company or the fund manager to probably look into the best investment opportunities outside there for it to invest this pool of funds and eventually get a substantive return and pay off the investors the agreed return, as I spoke about. Then the index is just a group of securities that represents a specific market. Like we have Nairobi Stock Exchange, we may have all the listed companies giving us an index. That is all Nairobi Stock Exchange index, or a group of security, like let's give them 20. I'm still giving an example, the Nairobi Stock Exchange, the 20 listed companies giving us that index. Then when we talk about annuities, basically this is for retirees, and it is a financial product that offers a guaranteed income stream, usually for retirees upon retirement. Then finally, when we talk about exchange, is the facility for trading of securities, mostly in the stock market or in the bond market. That's actually what we call the exchange. My dear audience, allow me to welcome the next presenter to take us through the 6-step process towards investment planning. And thank you so much.
Thank you, Joseph. Thank you, Joseph, for so far sharing your thoughts. So next, I'll take us through the 6-step process of investment. So the first step we have in the investment planning process is setting your investment goals. So, of course, for any plan to work, for any plan, whether it's any kind of plan, you have to have your goals set out from the beginning so that you know what you're working towards. So, for the investment goals, they have to be SMART. That is, that they have to be specific, they have to be measurable. So, by specific, we mean that what is it that you want to achieve at the end of your investment planning process? What is your, what is your end result that you want to achieve? They have to be measurable. So is it an amount that you want to have established by the end of, say, 5 years or 10 years? It has to be very measurable. Is it financial independence that you're looking at? That is what we're talking about, measurability. Then they have to be attainable. So they have to be realistic. For example,
Bernice, we're having a problem trying to get to hear you clearly. I don't know whether you may want to fix that.
how much time are you giving yourself? The next step in the
Yeah, apologies for that. We're having a bit of technical difficulties in hearing Bernice, but I'll take you through the 6-step process. And as Bernice has said, your goals need to be SMART, specific, measurable, achievable, realistic, and time-bound. So once you've set your goals in investment planning, you'll move on to understanding your investment personality. So different people have different investment personalities. There are those who love risk, and there are those who are risk averse. So knowing your investment personality is very key, because this will determine your length of investment and the type of investment that you will choose as a person. So once you understand your investment personality, you'll find it easier to actually align your goals so that you can achieve what you'd like to achieve. So understanding your investment personality is very key, because no two different people have the same level of risk appetite. There are those who have higher risk appetite than others. So knowing yourself as a person will help you better understand your investment personality. Then the third step, we have designing your portfolio. So this is the step whereby you now design your portfolio. As Mr. Andio had mentioned earlier, your portfolio is what you actually choose as investments. We've talked about stocks, we've talked about bonds, we've talked about the different instruments that you can invest in. So these different instruments that you can invest in, once you choose the different amounts to put in different things, that's what we call the portfolio. So before you design your portfolio, we had talked about your investment personality. So that actually informs how your portfolio will look like. So there are certain investments that are quite long-term than others. We have things like bonds, which sometimes they have a tenure of 1 year. So you find that that's a bit short term, but you find there are certain investments that are more long term, like 10 years and above. So the process of determining the amount of assets to put in various categories is what is called asset allocation, as had earlier been mentioned by Mr. Andio. So we move on to the next step, where you select the specific investment. So it is important to set up an investment account. So once you've designed your portfolio, you'll have your investment account. And in this account, you'll have specific investments that you have chosen as an investor, so as to align your portfolio to your needs and the period you'd like to invest in. So you have to build your portfolio in a way that is consistent to your specific goals. In the first step, we had talked about having your goals being. In the first step, we had talked about having your goals as specific. So these goals, they have to be specific, because you can't just say, I'm going to invest 1 million Kenya shillings. You have to be specific on where you're going to invest that 1 million shillings through your portfolio. The next step, this is where you manage and monitor your portfolio. Now that you've set up your portfolio, you know which types of investments that you're working with. You know that I've put this percentage of my earnings in bonds. I've put this percentage of my earnings in stocks. So the different aspects in your portfolio, you need to know how to manage them. And now, sorry about that. So the different aspects in your portfolio, you need to know how to manage them. So you'll keep on checking your investments and see what's more profitable for you as an investor and what's not profitable for you. So you can drop some investments and you can add some investments as you go. You find that now and then there are new things that you can invest in. Like nowadays we hear of NFTs. So once you get to know about new things that you can invest in, depending on your risk appetite, as we had mentioned earlier, you'll now see how you can manage and monitor your portfolio. You need to do this either monthly, quarterly, semi-annually, or annually, depending on how busy you are and how your investments are set up. If they are long-term, there's no need to keep checking. And if they have fixed income rates, there's no need to keep checking now and then. But if it's things like stocks, which vary day to day, you need to keep checking your portfolio so that you can know where to move your stocks and how to balance your portfolio. So the next step is rebalancing and reducing your portfolio if needed. So during these periodic reviews that we've talked about, if there's need to make changes, you need to make those changes. And through this is what you call now rebalancing your portfolio. So you can decide to redesign your portfolio. And most of the time you find that this is where someone who has the expertise in managing portfolios can come in and advise you accordingly so that you can have a greater understanding of where to put your money and what not to invest in, because there are some risky investments and there are some investments, new investments that come in now and then. So having someone to advise you, someone who has been in the market, this is very important for you to have as a person, especially if you don't have that financial expertise, or maybe your expertise is not as deep as the professional who can advise you better on managing your portfolio. So we'll look at now what exactly are the benefits of investment planning. So investment planning, as we've seen, is very beneficial. You can look and see that it's something that actually gives you interest on your investments. So through this interest, this is additional money for you. So this additional money is something that you, as a person, you'll find that it's something that can take you to the next level financially, socially, and also give you that financial security and stability and independence. So it's also a great way to save, because once you have an investment portfolio, you'll need to have money to invest. And this money, usually, it's money gotten from your savings. So it will help you to be more consistent in saving, and it will help you to save more. And through these savings, you earn interest. And that interest is compounded now and then as you keep reinvesting and readjusting your portfolio. So once you have an investment portfolio and you are investing in different areas, you find that it can become very easy for you as a person to efficiently manage your income. Because once you get your income, you'll now be able to save, as we talked about earlier. And also, through these savings, you find that you become someone who can easily manage their income. They get their income. Once you've gotten your income, you know automatically this much goes into savings, and these savings go into stocks. And the next savings perhaps will go into real estate, it will go into different kinds of investment. So you become someone who is financially aware of how to manage your own income. So through this, you also get a deeper financial understanding of how things work in the market. So as a beginner, you'll find that you don't really have much information, or the information that you have is more theoretical than practical. But once you begin as an investor, with the little that you have, you find that you keep learning about new things and how the market works. So having that financial understanding is very key, and it's something that will come to help you not only in investment planning, but in also managing all your finances and organizing your life and succession and all that. So it's something that's very important. then you find that as an investor, you find most investors that you know of, the big investors, you find that they usually have a lot of money. So having that a lot of money changes your standards of living. So you find that financially, you're growing yourself as a person, and most of the time, not only yourself, but your family. You find that you're growing as well, and your standards of living keep improving through investment planning. So with this, we see that investment planning is a very key thing as a person who wants to be financially secure, stable, and independent. So that's the end of the presentation. If you have any questions, I believe you have been putting questions in the chat box, and I'll hand it over to Christine. Thank you.
Thank you so much, Njuguna, as well as Andiwo, and Banis as well for the engagement that you have been able to just allow us to indulge in or engage in as well. I can see a question from Mombota. As investors, how safe are the funds? Andiwo, you may want to take that one.
Thank you so much, Christine. The question is, how safe are the funds under Arima Fund? Thank you so much. Now, Actual Services East Africa basically is having over 20 years experience in the industry of consulting, either under investment, IT, Actual itself, insurance, and so many. Arima Fund, as we were told earlier on, is the subsidiary. It's one of the subsidiaries of Actual Services East Africa, just like the Brooks that offers the insurance side, plus so many more. Now, how safe is the money? Now, first thing you need to do is to look into the company or the firm that you are engaging with, their track record, their books of account. Two, you also look into where do we basically invest that pool of fund I spoke of earlier on. That is likely to make you or be considered as unsafe area of investment. So what makes us safe as a fund is basically where we do invest and the governance committee we have in place that periodically sits to check on the performance of the fund in various asset allocation. That includes the well-performing stocks either in Kenya or outside Kenya, as well as that pool of funds that we have and invest in bonds under negotiated rates, either for corporate or government securities. So we have a strong governance structure that periodically sits to check on the performance of the fund and offer advice wherever there is a likelihood of us making more return or less return. All these are for the benefit of the company, that is the Arima Fund Limited, which is a subsidiary of Actual Services East Africa. Lastly, as far as safety, we also have the Actual Services East Africa, which is also giving the fund another entity or another opportunity to invest in. And there is basically where I talked about the track record. Actual Services East Africa, on one hand, has got that best and well-known track record in the field of actual consultancy. Over 20 years. In fact, last year we celebrated 20 years of our success in business. And therefore, by Arima Fund itself allocating some funds to related entities of the ACTSAF makes it even more safer for someone willing to invest in Arima Fund. I hope this answers the question that was posted by Wambuta. Thank you.
Thank you so much, Andrew, for answering the question so beautifully. We have one more question. Does a Arima fund consider one's occupation so as to qualify him or her to invest with them? Andrew, you may want to take that question.
Thank you so much, Christine. Does Arima Fund consider one's occupation so as to qualify them to invest in the fund? That is a very, very beautiful question. Allow me to answer this. Dear audience, before we, I hope I'm audible enough, before we take up anyone to invest in a Arima Fund, we do consider a number of factors, of which the occupation is also very, very instrumental. Remember earlier on we talked about the education that is necessary before making that basic step towards investment. You may have a farmer coming in as an investor. You may have a teacher coming in as an investor. You may have a lawyer coming in as an investor. You may have a financial expert coming in, having accumulated that strong financial foundation, coming in as an investor. The way or the kind of advice you're going to give to these different persons do differ. The kind of advice you're going to give to that medical doctor who wants to invest their funds in a Arima fund will differ to that kind of advice you are going to give to that farmer coming in, or that beginner, or that person who has really accumulated so many years and has got the experience in investment. And therefore, my answer is yes, we do consider, because it's necessary at that point that we do impact the investment knowledge to the investor before they invest their money. Because for them to understand time horizon, the risk tolerance, and the kind of product that they are venturing into, it is always very, very key to consider one's occupation before venturing into an investment. I hope that answers the question. Thank you.
Thank you so much, Andeo. To our attendees, we can take maybe one more question. In the meantime, maybe you can share with us your email addresses. The team will be happy to share with you the presentation after this. We have room for one more question. Okay. Thank you so much for joining us to today's webinar. I believe all of you have been able to grasp as much when it comes to investment planning as a result, and also make the decision to join the investment fund, Arima Fund. Once again, thank you so much and have a lovely day.